Hey, this is Chris Sanderson. I'm the Director of Training for Ruoff Home Mortgage, and I wanted to make you a quick video. We've been getting quite a few questions about people getting a statement. It's called an escrow reconciliation statement is the fancy term for it, but basically telling people that their payment is going up. And we've been getting questions like, how does that happen? So I wanted to see if I could run through real quick and help you understand. So the best way to think about this is a piggy bank. We've all saved money in a piggy bank. You want to go to Florida next year, you need $1,200. You got to save $100 per month. So by next time this year, you'll have the money to go to Florida. Same thing is true of your mortgage. So when you buy a house, just for an example here, let's say this is a $180,000 house. So what do we have you do? We have you get an insurance quote or an homeowner's insurance policy. So on a house like that, I don't know, maybe this is $900 a year. So we know what to expect. You're going to pay for the year up front, and we know that next year another bill is going to come this time, and it's going to be hopefully around the same. We also look up the property taxes. And let's just say this house is $1,800 a year on property taxes. Now I've got the little asterisk saying, let's just assume this is January 1st. That makes it easy. Let's say the insurance is going to be due on January 1st. The taxes for the property taxes are going to be due twice a year in May and November. So this is going to be $900 in May and $900 in November. So that's what we're expecting. So we say, okay, this here, what's that, $75 a month? For insurance, we need to collect and put that in the monthly payment. Property taxes, that's $150 a month that we need to put in the person's payment. So combined, we can look at this as $270, which would be $225 per month that we would need to put in the escrow account, right? So that's what we are hoping for, $225 a month. So that's what we're expecting. We say we're going to collect your mortgage payment, and in that will be $225. $225 every month. Taking that $225 out of your payment, we put it in the piggy bank in hopes that next year this bill comes in at $900, these are $1,800, and we have enough money to pay it. So we just do that the whole year. And then at some point there's an escrow reconciliation where the company looks at it and says, okay, we've been collecting $225 a month, but how much are the real bills and how much do we need to pay out? So if we were expecting $1,800 in property taxes, but let's say, oops, the next year we got notification that this is going to $2,400, and your insurance is not $900, it's going to be $1,200. So here we got $3,600 a year. Oops, $3,600 a year, so we need $300 a month. Uh-oh. So here's where it gets tricky. So this is called a shortage. Your payment's going to have to go up by $75 to pay these bills. And most people think like that's where it ends, right? That's bad enough, $75 a month. But here's the problem. We've been collecting $225 this whole year. Then the bill comes in. We were expecting $900, but the bill comes in for $1,200. And then down here, this instead of $900 comes in for $1,200. And this one happens to come in for $1,200. See, we were only expecting $2,700, but instead we got bills for $3,600. So that's where the shortage comes in, because now we collected $225 a month, but we owe more than we collected. So the company, usually the mortgage company, gives you two options. One is make up this shortage. Right here, I'm $900 short. I can just send in a check for $900 and have my payment go up in the future by $75 a month. Well, some people don't either want to or they don't have $900 sitting around. So they say, look, take that $900 and we'll make up for it over the course of the next year. So $900 is another $75. So my payment is going up by $75, but then I got to make up this shortage. So we're going to add another $75 per month to make up for the shortfall. So hopefully that makes sense. That's what the escrow reconciliation is when these bills come in higher, and that's usually if your property taxes or your insurance went up. It can also be the opposite, by the way. Let's say you bought a foreclosed house and the property taxes were through the roof. They were $3,500, but now that it's owner occupied and you're living there, maybe your tax bill goes down from $3,500 a year down to $1,800 a year. The opposite is true. They say, holy smokes, we were expecting this to be $3,500 over here, and it came in as $1,800. So we can refund the people the escrow surplus, and we can lower their payment going forward. Unfortunately, that doesn't happen to a lot of people, whereas things going up does happen. So hopefully that answers your question. If not, get a hold of your loan officer or call me direct at Ruoff, and I'll be happy to help. All right? So you have a great day, and I hope this helped you out. Bye-bye.